Welcome back to the channel. I'm Foreman, and today I've got a paid stock request on Fiverr. This will be my stock analysis on Calnex Solutions, and this is a stock that I've not held before, but this is one that's actually been on my watch list for quite some time. So firstly, a shout out towards Mark for paying for the suggestion, obviously, and I hope to deliver as much value as possible. He mentioned, hi, Oz, love your videos. It's also a nice way of me giving you some cash as thanks for entertaining us in the stock market. Also use some of the profits I made back on you, or from you. CLX, or Calnex Solutions, got their update on the 23rd of November, so he does mention that he doesn't mind if I was a little bit more patient with it. But I think there's more value in making this stock analysis right now, because this trading update could obviously come up and shares may retrace. It may become a buying opportunity, perhaps. Perhaps shares are overhyped at this point in time, but I'm only speculating right at this moment. And so I feel that having this information now could be a good thing, especially if you wanted to get in before the trading update as well. He mentions that he first looked into the company after a journey into stocks, talked about them, and is now up 70%. And also in 5 years' time, it would be a great growing company with 5G and cloud data, as it is an already profitable company. I'd love your more skilled take on them and what you think they're fair/good buying prices. Well, thank you again, Mark, for putting in the suggestion, and I hope to deliver on this video. And if you like the video, please drop one of these to help beat that YouTube algorithm. So starting with simply Wall Street, Calnex Solutions is basically in the 5G and cloud space, as Mark had mentioned, and this is for test and measurement solutions for mainly telecommunications companies, although some other companies as well. In terms of valuation, you may look at the price to earnings ratio and think, oh, that's quite a high PE. That would, at least you'd anticipate, quite high growth. And I think that this price to earnings ratio is a little bit flawed. This is because it's taking into account a trailing 12-month price to earnings ratio, which means it's taking into account previous earnings. And we certainly know that this company is likely going to have a lot more cash now, especially if they're reporting their trading update, which will be their interim results on the end of November. So there's certainly a lot of potential for this price to earnings ratio to actually look a lot lower than it truly is. Again, with price to book ratio, it still looks fairly overvalued, and this is likely because they are a very capital intensive business. Telecommunication businesses usually are very high on capital expenditure. You've got the likes of BT and Vodafone having that infrastructure, and they're spending so much money on capital expenditure that they're not even really breaking even in terms of growth of their company. Calnex Solutions has a similar sort of style where they do need to reinvest a lot of money into research and development, but they're not limited by, for instance, equipment depreciation, because after all, they sell hardware and software, but a majority of their sales are hardware, and I will be talking about this later. In terms of their past performance, their 5-year CAGR, or compound annual growth rate, of their earnings is 28.7%. This is actually very impressive to see a company of this market cap of £128 million being profitable, and this profitable of 19.2% profit margins, and even better free cash flow when I add that in. This is certainly a very good sign to see. We can see the top line is growing. Yes, it looks like the earnings has taken a little bit of a hit. I'm going to guess there was a one-off point there that really had decreased their earnings potential for that given time period. I do love about this company, though, is their financial health. This financial health is fantastic. They have absolutely no debt, but they have £12.5 million of cash on the balance sheet. That is 1/10 of their market cap. That is a high amount of cash to have, and at least then you have got some value down there on the balance sheet. Obviously, they aren't a dividend payer, but in terms of ownership, I really do like this, because their ownership, or at least who holds their shares, is very interesting to see, because we can see that individual insiders take up 25.5% of the total share count. That represents significant skin in the game, and we can see that the biggest shareholder of this company, Tommy Cook, is the CEO and also founder of the company and holds 21%. This is amazing skin in the game, and you can tell that his motivations are likely going to be driven alongside his own company, especially as the founder. When we look at his actual tenure itself, it doesn't say, but the average tenure of this young business, is 7 years. So that does look quite promising, but that might just be using the only data points available on the screen. When explaining how Calnex Solutions' business model works, basically they operate in a few different segments. They focus on design validation conformance test, and maintenance test. As you can see at the bottom of the screen, we can see the ones highlighted in the bigger circles is what they go for. And they do this because these are very critical points in the development life cycle. And this is because it requires high capability and high value added test equipment where there is limited competition. Furthermore, their differentiation, the company's principal focus will remain on developing new features and products in Calnex's core markets, meaning they're not trying to expand out and get into every slice, get their fingers in every pie. They're focusing on clawing up market share in the industries, or not industries, but in the segments that they know the best. And this could definitely be some form of disruption, especially if they continue to claw up this market share and become very strong market leaders. They even suggest that they've already got a strong market position with limited direct competition, and this is a very promising side to see. Furthermore, you can see that Calnex's products are often differentiated by their high specifications and the complexity of the product platforms. This is where I come back to the whole idea that the company is very much focused on research and development and intellectual property. They need to continually invest lots of capital in order to really push the growth of this company and stay ahead of their competition. But if they're able to do this, they can achieve very healthy margins, as they have mentioned here. And when we look at the idea of what they provide in terms of hardware and software test solutions, they have three main application ranges. They do test capabilities based on their Paragon product range, which I believe is just below here. The Paragon basically is through one of the first offerings, and basically the idea is that they're ahead of the curve, right? They were the first to offer multi-rate to 10G. I can't even pretend like I understand this, if I'm honest with you, but it is showing what they've got is very highly specified kit that you're likely not going to get elsewhere. Maybe there's competition now, but as Calnex have mentioned, it's likely going to be very limited. Furthermore, we can see that their field synchronization kit, which is their Sentinel product, is apparently the best in class in maintaining high accuracy time in the field. You can certainly see that the companies that would want to use this are the companies that have the capital available. These companies are the ones that are really looking for very accurate testing, and they want to make sure that their product quality is good. Furthermore, we also have the cloud and IT bit, which is where we look at SNE and Actero 100G, which supposedly again are one of the first offerings in these fields. So you can certainly see a high level of specification, again tying to the idea that they're going to have to spend a lot of capital to stay ahead of the curve and win with these. In terms of their revenue streams, I think it's quite promising because their geographical split is actually very balanced between the Americas, North Asia, and the rest of the world. It's like 33% each. It's like they've got three main core markets, and I like that a lot. Their revenue streams, obviously, I would love a bit more software, but you can see that it's growing. Perhaps it's not growing by as much as the rest of it, such as their hardware revenue, but it is certainly promising. The warranty support revenue is certainly building up, and it adds to the diversification on this. As mentioned earlier, the telecoms versus non-telecoms customers, the ones that aren't telecom, which is the minority, are apparently predominantly derived from the hyperscale data center and enterprise customers. Again, I can't really pretend to really understand what these are, but apparently they represented 23% of the company's revenue in the full year of 2021. And what we can see is it does look like there's a slight increase into that side, but at the same time, this is likely clawing up against the telecom customers, and that could be a good sign for the future. Telecom, the industry itself, as I mentioned earlier, is quite high capital expenditure. Some of these businesses do struggle, or they have massive pension deficits, not naming a certain one like BT. And the idea is there, so perhaps having some more diversified or non-telecom customers could be a good sign for the future as well as their repeat revenues. And what is important to note here is that their relationship across the top 10 customers in the full year of 2021 is 9 years. This means they have a high level of repeat demand. This is what you want in any company. You want customers to continually come back. You want them to come back and buy more products. What it's showing is that Calnex product offering are not only very profitable, not only are they top of the range, but because they're top of the range, the customers are coming back. They're willing to pay the premium because they know the kind of quality that they will get. And in terms of that, we can see why the revenue has been growing massively, and a gross margin of 78% is really something to think about, especially when you think about the underlying earnings before interest, taxes, depreciation, and amortization is 31%. For instance, if I compared that to my biggest holding, Boohoo, I think they were initially on about 9.5% with long-term goals to hit 11%, and at the moment they're much, much lower. You can see here the whole idea that their capitalized research and development is pushing up. But this could also be a good sign, because if they're able to generate returns on their capital at a strong level, this means that effectively they could reinvest more money and their revenue is going to grow further. Although we may be seeing this eating into their earnings a bit, so they may become less profitable over time, although their EBITDA would not suggest that. So perhaps I could be wrong here, as their profit before tax is increasing as well. But as long as they're researching and as long as they're reinvesting a lot of their revenue into staying top of the line, staying that premium brand, and staying ahead of the curve with their technology, then their revenue is going to grow. They're going to continue clawing up market share in a market that I believe they have stated for one segment is $1.3 billion and is expected to grow by the 2024 to $1.8 billion. These are figures I've quoted off of the top of my head, and I may be wrong here, but I did remember reading this in the annual report, and it is certainly in there if you do look for that. Their distribution channels means that they have a long-term relationship with Foreman Communications. They are a FTSE 250 listed company that are in a very similar niche, and it's good to see that they maintain a good relationship with them. Their manufacturing is what interests me. Typically, I'm a fan of vertical integration. I love it when a company creates or has control of their entire supply chain. But in this case, outsourcing their hardware needs to another company could prove to be more profitable. It means they haven't got to worry about that, maybe not more profitable, but more safe. This means they don't have to worry about doing that, and they can reinvest the other capital into constant R&D. And it's of note because Kelvinside Electronics, which is the one that operates for 20%, well, this is what Calnex orders are. They operate as 20% of that company's revenue. This is obviously quite a large amount. This means this company very much depends on this. And providing Calnex obviously are growing a bit more, this company is going to become more loyal. They're going to want Calnex's custom more than ever. And as that happens, they gain more pricing power. And is it really a surprise to see that very recently, I believe 3 weeks ago, Calnex have said that they've got a profit upgrade. They upped their full year profit guidance amid continued strong levels of demand for its telecommunications testing equipment. In fact, in the trading update for the 6 months to the end of September, they said that robust level of trading is expected to carry through into the second half of the year. As a result, revenue and profits for the full year will be materially ahead of previous expectations. A very promising sign, but at the same time may be the reason as to why shares are certainly at a very high price now, because in the last year they have run up 155.7%, and you can see when they upgraded the guidance, the shares since then have really gained some hype. So in my opinion, we may see shares continue to build hype, and they may get up to this trading update or their interim results in November 23rd. And at this point, we may see shares cool off, or if the results are really better than what investors had priced in, shares could certainly push back up. I think their price to earnings ratio is obviously going to be outdated, but when you look at a price to sales ratio, this is quite the premium you would be paying for this company. But then again, when they do have such a high level of profit compared to their revenue, you could certainly see this business scale up quickly, and the price you would pay today really wouldn't matter that much compared to the price you may have the shares holding in 5-10 years time. I think personally, I'd be looking to get a little bit of a deal on this. I think there's a bit of hype at the moment. This positive momentum could be a good thing, and there may be some technical analysts out there going, well, actually, this is creating some chart that means there's an upwards trend, positive momentum, the weekly trend's up, you should be buying. Quite frankly, I don't know what that means. If I was looking for a long-term opportunity, I would maybe hold off for a little bit. Obviously, we already know their upgraded guidance is suggesting that, yeah, it's materially ahead of previous expectations. And so basically the markets are now excited. There's a lot of euphoria. There's less fear, uncertainty, and doubt, and shares are going to be pushing up. But then again, you could always average into a position like this, and that would make a lot of sense too, because if you bought half now, before the trading update, and you bought half after, if it goes up, well, then you've made more money on your initial investment, but if it goes down, you get a better price on the second bit. So I would be looking to try and get a price that is roughly I would say around about 130 pence per share. That would be me trying to get a good deal, considering how much they've pushed up recently. And I probably wouldn't put all of my money in at once. This is, after all, a lower market cap stock. There could be a lot of volatility with this. In fact, I believe their weekly volatility, which should be down here, is roughly 6% a week, which has been stable, but still a high amount of volatility. So you could certainly take advantages of dips in that regard. And that's the beauty, really, of AIM listed equities, is sometimes the volatility is quite high. You can buy in at a low point and then get out just in time. But then I don't try and trade, but it's very good for buying the dip. I do like Calnex. They are certainly one that's going to remain on my watch list, but not really my top priority to buy. And this is because, despite the research that I have done so far, they are a complex business to me. But then again, if you're in the telecommunications industry and you understand why Calnex is delivering value with their premium high-end product ranges that are really in a very secure market of limited competition, then this certainly does look very promising. And in fact, I think if shares did drop to a certain amount and I had the capital available, I would be very interested in buying shares of this stock. And if you're interested in making a stock request for yourself, I'm going to leave a link in the description down below. There are some rules involved, such as not requesting the same stock that has already been called out, and also not buying multiple orders at the same time, because it just gets very overwhelming. That is a short fix at the moment. I'm going to be creating a Patreon with a voting system in the future, although at the moment I'm just going to take my time until I can really deliver appropriate value. I know I had a Patreon in the past, but I think that one lacked vision. This time I think there will be a lot of vision with it. And if you're interested in my Boohoo stock analysis, then click the card at the top right of the video. Thank you for watching. Have a fantastic weekend.